Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
Hello, and thank you for joining us for this podcast. This episode is going to be on the One Big Beautiful Bill Act, which we're going to refer to as the Act, as it's a very long name, and the impact it has on businesses. So the Act is landmark legislation passed on July 4th, 2025. You might have remembered President Trump was signing it on Independence Day, on the 4th of July with jets flying overhead. But it has a lot of key provisions for businesses. The Act is comprehensive legislation and includes key changes related to incentives for businesses. So it's important that businesses or their advisors understand how to navigate these complex but understand, how to take advantage of effective planning for these new laws. I'm Chris Klug of Basswood Counsel, and with me is Gina Lee, also of Basswood Counsel. And so we're going to take you through some of the key business provisions in the Act. Gina, under the Act, what happens with the qualified business income deduction? Maybe explain briefly what it is.
Yep. So qualified business income deduction, which was introduced under the 2017 Tax Cuts and Jobs Act, allowed up to 20% of deduction for qualified income gain, deduction, and loss from a qualified U.S. trade or business, provided that the taxable income did not exceed 20%. So under the Act, the qualified business income deduction stays permanently, and the deduction amount or deduction percentage actually increases to 23% beginning 2026. Okay. The phase-out range for the qualified business income deduction also increased from $50,000 to $75,000 for single filers and from $100,000 to $150,000 for joint filers. Now, just remember that these are eligible for taxpayers who are sole proprietors, owners of pass-through entities such as partnerships, S corporations, and LLCs, and C corporations are not eligible for the qualified business income deduction. Now, the Act also sets a minimum deduction for active qualified business income for applicable taxpayers at $400. The taxpayers must materially participate in an active business and have at least $1,000 of qualified business income from that business. And this minimum deduction, which is new, will be annually adjusted for inflation after 2026.
Okay. And then just taking a step back, so the qualified business income deduction was initially passed under Tax Cuts and Jobs Act of 2017 under Trump's initial term. It was set to phase out in 2026. The purpose of it, and the reason it doesn't apply to C corporations, is that a C corporation has an entity level tax, and the C corporation is subject to tax at a flat rate of 21%. And so they're trying to encourage business. Pass-through entities, if they didn't have this deduction, would be subject, the individual owners where the income passes through, would be subject to tax at rates up to 37%. And so what this deduction does is drop, if you maximize the deduction, it will drop that pass-through tax on that income down to about 27-28%. So that gets it more equal with the corporate tax rate. And then in planning on should you have the entity tax as a C corp or as a pass-through entity, the question is, a lot of business strategy, you got to play a lot of assumptions, but 21% flat tax plus dividend tax to get out to the individual compared to about 27-28% tax. And there's some other benefits we'll talk to that go into the factoring of which way you plan to establish your business and what's the best alternative way to be taxed. Gina, research and experimental expenditures. Now, almost all countries incentivize research and development expenses with, either tax credits or, additional taxes. But the Tax Cuts and Jobs Act actually made it negative on the expense side for businesses. And what's going on under this act to fix that issue?
Yes. So under the Tax Cuts and Jobs Act, starting with tax year 2022, the prior law required amortization and depreciation of over 5 years for certain specified research expenditures, and the amortization period was actually 15 years for research performed outside the United States. Now, under the Act, it allows permanently reinstating the immediate expensing of the domestic research and experimental expenditures with an election to amortize certain expenditures. And this can start with tax year 2025, which is the current year. And this will greatly benefit a lot of businesses spending on AI or any other research and experimental expenses inside the United States. So any amount paid or incurred in connection with the development of any software is treated as research and experimental expenditures. Just wanted to point out that businesses with gross receipts of less than $31 million can claim this deduction retroactively for tax years from 2022 to 2024. So, going back to how your research and expenses were in the last 3 years can be a benefit for certain businesses. So amending tax returns for those prior years can be something to consider.
Yeah, and just from a practical standpoint, I've run into situations where we had someone who did research outside the U.S. on behalf of U.S. companies, and they had us look into, and this provision still stands, that you have to amortize foreign research over 15 years. So their client who was hiring them to do the research stopped the contract and canceled the contract because that's a long time to amortize big expenses. And then, we've run into another situation with something that falls under that $31 million revenue range. And, they had research and development expenses of more than, let's just say, $2 million a year. What happened in 2022? Instead of having a $2 million deduction as they did in every other year, they got a $200,000 deduction. And then on that amount, $400,000, after that. But, you have to imagine, that's a $2 million profit margin you have to be able to meet, and then you have to be able to get enough money to pay the taxes on that amount. So this reversal for small and medium-sized businesses in the U.S. is huge. The fact that companies with under 31 million can go amend 2022 through 2024 and now claim the expenses will result in refunds to these businesses and will result hopefully in more investment in the company to do more research, which should be encouraged. This is a big change because it's had a devastating effect on a lot of small and mid-sized businesses. This is an activity that should be encouraged. Gina, how about bonus depreciation?
Yes, the Act actually makes the additional first-year bonus depreciation for certain qualified business assets permanent at 100%. Now, under prior law, Tax Cuts and Jobs Act, the bonus depreciation percentage was decreasing from 100% to 80%, 60%, 40%, and 20%, and it was going to phase out after 2026. Now, under the Act, the 100% bonus depreciation that you can take the first year that you acquire business assets is effective starting with January 19, 2025, and it applies to both new and used assets, provided that they were acquired in an arm's length transaction and not previously used for business. And assets must have a recovery period of 20 years or less. There's also a new 100% bonus depreciation provision under the Act for qualified production property, which is certain non-residential real property used in the manufacturing, production, or refining of certain tangible personal property. And this will be effective for property placed in service after July 4, 2025.
So maybe like a manufacturing facility for iPhones in the U.S.
Oh, yeah, that is certainly an incentive that the new Act is hoping to draw.
Yeah, what's interesting in staying non-political, in some of the businesses that they want to be brought back to the U.S., some of these tariffs that are out there, is the interplay of, in the U.S., do we have the people at the price needed to to produce these goods like an iPhone without drastically increasing the price? Do we have the facilities? And so there's a lot of questions out there. So we have tax policy that's encouraging the activity. Is it going to work out the way it should? And we'll leave that to the politicians. How about Section 179 expensing limits?
For property placed in service after 2024, the maximum deduction limits for the code section 179 expensing is increased to $2.5 million, and the phase down threshold is increased to $4 million. These limits are both subject to inflation adjustments going forward, and these will provide businesses with greater flexibility and larger upfront tax deductions, hopefully.
Yeah, and one of my favorite planning opportunities in planning, especially for entrepreneurs who really enjoy working with entrepreneurs and help them work out how to, when it comes to the end of the day, when they sell their business, to get the most out of their blood, sweat, and tears, all the long hours they put, sometimes not properly compensated because they're building something. And so there's this tax benefit called qualified small business stock. And qualified small business stock only applies to C corporations. So in choosing the entity, this is something that factors in. Is there an exit? What is the planned exit? And are you looking to sell? What qualified small business stock allows you to do is exclude the greater of $10 million or 10 times your basis in the company. And so at a minimum, you're getting, under prior law, you got $10 million. For a while there, right at the beginning of the qualified small business stock treatment, we call it QSBS. There was a period where you could exclude 50% of that $10 million, so really $5 million. And there was a period where you could exclude 75%, so $7.5 million. But starting in, I think, 2010, you can exclude 100%. Under the new law, you can, and under the prior law, it only applied to contributions into the company for the first $50 million. Under the new law, that contribution limit is capped, is increased to $75 million, so a much larger range, allows an additional $25 million of investment to qualified, stock for that treatment, and it increases the exclusion from $10 million to $15 million. So that's a big benefit, and so think about that. You start a business, maybe you contribute, if it's software, maybe you come up with something and it's really all your work. So, the contribution, let's say, was $100,000. 10 years later, the software has become very popular. You're now able to sell it, and you sell it for $15 million. Well, under the new rules for qualified small business stock, you recognize no gain. And so when we're planning with clients, we take into consideration their planning strategy, because maybe, as compared to pass-throughs with C Corps, if you're just going to reinvest all the time, then you're trapping the tax at 21% because you're not making dividend distributions out. And if your plan is to sell at the end of the day, and that's how you're going to get your big kick out from your work, if you can exclude $15 million, that's a big benefit. And when it comes to acquisition, you can work with the buyer on how to get cash out the most efficient way. And then when you look at pass-through entities, if your plan is to reinvest, well, you're paying tax at an additional 7 or 8% higher on an annual basis. So, and you don't get the exclusion, so you lose $15 million of gain exclusion. So it's very important to understand what the owner's goals are in choosing the right structure. Under the Act, there's an enhanced manufacturing investment credit for what do they call for microchips manufacturing or semiconductor credit chips. Sorry, it's known as the CHIPS credit. And qualified investments in advanced manufacturing facilities built before January 1st, 2027. The credit is increased from 20% to 35%. So that's a 10% increase on that credit. These facilities are usually expensive, so that's a big credit. Information reporting on Form 1099-K. For those that don't know, a Form 1099, depending on what the letter after it is really an informational reporting form that goes to the IRS to say this company or this person got X amount. And The threshold has been increased for reporting on a 1099-K to transactions of $20,000 or 200 transaction threshold. So less people will have to file the 1099-Ks now. For information reporting for forms 1099 NEC, 1099 miscellaneous, this is where you report income for self-employed people. And this is, again, a way for the IRS to gather information on who's receiving income. You might know the IRS doesn't always trust people. So left to your own forces, if the person making the payment didn't have to say, this company, I paid them $15,000, that company may not report that on their tax returns. So that's the purpose of these 1099 forms. Threshold for filing a payment made increased from $600 to $2,000. So again, there's going to be less filing of the Form 1099 miscellaneous and NEC for smaller transactions. There's also a provision on the gain on the sale of certain farmland. So for sales or exchanges occurring after July 4th, 2025, sellers of qualified farmland can pay the gain on that sale in 4 equal installments, starting with the first installment due with the tax return reporting the year of the sale. And then each year after that, you can report, an additional 1/4 of the gain, an additional. So that's tax deferral. It's nice for the farmer. Hopefully, if you miss a payment, then the whole amount due gets accelerated. And hopefully, you plan well enough to keep enough money to pay that tax in the future. And then there's a deduction limitation on compensation paid to publicly held corporation executives. So the law was that publicly held corporation executives, the first $1 million was deductible, and amounts paid to them above that are not deductible. That just included the publicly traded company. Starting in 2025, it now includes members of the affiliated group of the publicly traded corporation. So that, if publicly traded corporation X has ownership in, majority or controlling ownership in 30 other corporations, this limitation now applies to those 30 other corporations. So it's a big change. And then one of my favorite topics is the qualified opportunity zones, which came out in the 2017 Tax Cuts and Jobs Act. And the benefits under the qualified opportunity zones are kind of winding down. So 3 key aspects of the qualified opportunity zone are an investor or someone can sell property, and when it's sold, it generates capital gain. Well, if you invest it in a qualified opportunity zone within the required time periods, that gain's deferred. It used to be for at least 7 years or until 2026. And then the second aspect of the qualified opportunity zone, so you get tax deferral. If you hold that qualified opportunity zone fund for 5 or 7 years under a prior law, if you held it for 5 years, you got a 10% reduction in the gain recognized. So if you recognized 100, you hold it for 5, you now recognize you're taxed on 90. So you reduce your tax. And then if you held it for 7 years, you can reduce it by 15%. And then the third benefit is, let's say it was $100 that you invested in a qualified opportunity zone fund. If you hold that interest in the fund for 10 years, let's say it's now worth $500, you don't recognize gain on that $400. And so you get tax deferral on the initial gain. You get a reduction in the tax due on the if you hold it for a certain time period. And then when you sell the interest, any growth in the fund, if you hold it for 10 years, is not taxable. So this is a tremendous benefit. And the new act that was passed improves. Well, I don't know if it necessarily improves, but it kind of recaptures the benefits so that qualified opportunity zone planning is beneficial in the future as well. So under the new act, it doesn't go away. So qualified opportunity zones, the ability to invest in them were supposed to go away in 2026. Now they're permanent. And under the new act, not only can you exclude capital gains in any amount or defer tax on capital gains in any amount, you can defer tax on ordinary income up to $10,000 per year. And so, or per fund, per investment. And now the rules are, you get to defer the tax. And if you hold it if you hold the interest in the qualified opportunity zone for 5 years, you get to reduce the amount of that deferred income by 10%. So again, you're getting a 10% tax savings or reduce the amount being taxed by 10%. And then again, if you hold the investment for 10 years, then you any gain from your investment until you sell it is not taxed. So it preserves the three benefits. There's a new category for qualified rural opportunity funds, and in those funds, instead of reducing on the deferred income, for the 5-year period or whatever it is, on that deferred income, instead of reducing the amount by 10%, you get to reduce it by 30%. So that's a big change. So yeah, qualified opportunity zones, they're going to be a planning tool in the future. It should be good for businesses, especially looking to raise capital if they can qualify. And so I think it's an exciting opportunity for both businesses and investors. Gina, how about the corporate charitable contributions?
Yes. So under the Act, the Act imposes a new 1% floor on corporate charitable deductions after 2025, meaning the total contribution must exceed 1% of their taxable income. And this is in addition to the 10% ceiling on deductions that is currently in place, that the maximum deduction for corporate charitable contributions must be below 10% of their taxable income. So the new part of the Act is if a corporation's contributions exceed the 10% limit, the amount disallowed due to the 1% floor can be actually carried forward to future tax years, allowing for potential deductions in subsequent years. Okay.
And what about for excess business losses? How does that change under the Act?
Yep. The Act makes the Code Section 141L limit on excess business losses permanent. So for 2025, the cap on allowable business losses is set at $313,000, and any excess losses will be treated as net operating loss in subsequent years. So the non-corporate taxpayers can carry forward their losses indefinitely.
Okay. And then there's a lot of changes with energy-type tax credits. Can you run us through those changes?
Yeah, so I'm just going to quickly go over some of the energy credits, and a lot of them are being terminated under the Act. So first of all, the energy-efficient commercial building deduction for the cost of energy-efficient commercial building property whose construction begins after June 30, 2026, will be terminated. The cost recovery period for energy property, which was 5-year maker's classification for energy property effective for property whose construction begin after 2024, will also terminate. And then another one, advanced energy project credit, effective July 4, 2025, the add backs in the event of the revocation of a project certification will discontinue. Another one, advanced manufacturing production credit, which was supposed to help the wind energy components produced and sold after giving the credit to those kind of wind energy components produced and sold, will also terminate after 2027. And in addition, the energy efficient home improvement credit under Code Section 25C is going to terminate. The new energy efficient home credit under Code Section 45L will terminate after June 30, 2026. And the residential clean energy expenditures credit will also terminate after 2025. So homeowners should think about completing their energy efficient improvements before the deadline, which is usually 2025, to claim the credit. Now, in addition, when it comes to clean vehicle credits, the credits for new and previously owned clean vehicles, including qualified commercial vehicles, will terminate after September 30, 2025, which is quickly approaching. So be mindful of whether you want to purchase a hybrid or a electric vehicle before that date. Alternative fuel vehicle refueling property credits, which is essentially, cost to install an EV charger at your home or at your business. This credit will also terminate after June 30, 2026. So just be mindful of that if you are having that project being started or in process. A termination of all these various energy credits will certainly greatly impact energy projects that are either being started or being continued. So this is a lot of changes on energy credits.
Yeah, we've certainly seen this impact our clients as well. They put projects on hold, but significant projects, and now it's determining where the business goes. Because that's, for example, if you're in green energy, now all of a sudden the credits go away, which is a way to attract investors. So yeah, it has a big impact on clients. Well, thank you for that. The Act provides businesses with a lot of planning opportunities. It's important to know what's changed. So if you know you should go forward with a project, or should you shift to other types of products, what type of investments should you make, or are tax advantageous? So the Act is very important when it comes to business planning from a tax point of view. I want to thank you for listening to this podcast. And again, you have Gina and Chris of Basswood Counsel. And good day, everyone.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.